Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 5th, 2016. A quick look at the markets right now. In pre-market, we're poised, on another monitor, I'm looking at the streaming quotes of the streaming charts of the major indices, the SPY, the Q, the IWM. Looking at the future, so we're poised to gap down right now to about at least in the Qs, which is what I'm focused on, right around the 109, just a hair above the 109 level. And so I wanted to talk about what to look for today. I mentioned this in the trading room yesterday. I don't get excited about the day-to-day gyrations. Market gaps up, the market gaps down, gaps are bought up, gaps are typically they've bought up a lot of the down gaps lately. The trend has been up, so on gap downs, you've seen, the buy the market up. We had that happen yesterday. That is all choppy intraday noise. At least depending on the time frame you're trading. Right now, I'm wearing my swing trading hat. Been preoccupied with a lot of stuff on the site, so I haven't really done any day trading or active trading lately. However, nor would I be at this point. This isn't really, we've been pushing up against resistance, as I mentioned yesterday, for the last 4 days. This will be, well, we won't be here today, at least not at the open, but we had 4 days essentially struggling with that key gap. I'm referring to the gap back on December 31st to January 4th gap, and then the reaction high. That's the level I'm looking at. Technically that's the bottom of the gap on here on the January 4th, but I look at if we have a follow-up reaction, that's really what I like to define as the gap right here. This area from that point down to where we had that reaction high the following day, and that's what we've been pushing up against for the last 4 days. So neither bull nor bear can declare victory yet. Markets are extremely not extremely, but quite a bit overbought on the daily time frame, just rolling off that 70 level. So we are just coming off overbought readings. And, the thing is resistance, and until and unless broken. And these were areas, that I identified as possible targets weeks back, and that's where we are. So nothing's changed. I still expect the markets to turn down here, and if they don't, the next stop is the top of that gap there around 111.80. But I'll make this quick. All I'm looking for today, I'm not getting too excited, even though I am short about this gap, because let's just take a look at that candle. That's where we're trading right now. We're trading just above 109, and so what that'll do, the gap down, assuming that that's where we remain. We're not going to do that. When you gap down this much, that gap's either going to get bought up or built on, meaning we continue lower. But right now that doesn't do anything because it still keeps us within that big bullish engulfing candlestick on Friday. The real damage will come, as I just posted in the trading room, if and when we take out the bottom of that candlestick from Friday. So call it around 108.40ish, and that would be a knife through the bull's hearts. I'm sure that fired up quite a few bulls, big bullish engulfing candlestick. As I mentioned when I came back in town, on Sunday, that didn't really do anything. Although bullish engulfing candlesticks are potentially bullish, it happened right up to and at and below, I should say, that gap, that green line, again, that January 4th, January 5th, the top of that gap there. So we're still kind of in no man's land is what I'm getting at here. Now, what I'll be looking for, and I imagine we'll have a resolve soon. I doubt we'll trade this close within this tight a range for more than another day or so. So my guess is we'll either take out the bottom of this candlestick, which would be a bearish technical event number one, let's call it, or we take out the bottom of that gap and we go on to, as I mentioned, if we get up within there, I said about a third or so, maybe even a little more than that, maybe even above yesterday's highs, we'll probably backfill that gap. I still favor the downside scenario. Nothing's changed at all in really in weeks. And you can see here we have that trend line with that Friday's big bullish engulfing candlestick back tested that trend line. See here the rising wedge pattern. We had a breakdown and a back test up to that point. So now we're going to gap down. And again, I don't want to make too much of short-term especially intraday action, but these are the things I'm looking for. So if you are, well, whether you're long, short, bullish, or bearish, those are the facts. That would be a technically significant move, if especially if it happens today, to see a big red. Well, it'll appear right here once the market opens. I'm doing this video in pre-market. So a move below there, and that is actually the low is 108.39 as the low of Friday's candlestick. Then I had this horizontal line around 108.08, give or take. And what that defines is, you look at these candlesticks here. See this sideways trading range? It went on for a couple weeks right here. This is how the markets move. This was a key resistance level back in, was that early March? Yeah, late February, early March. The markets, we had reactions here. Failed to get through there, made a few attempts, finally punched up through there, so that's a breakout. So we broke out, we back tested from above, and then we had a sideways trading range. What I'm getting at here is, especially at times like this, at critical market junctures where we're at, I think just about anybody agrees on that. This is a critical market juncture, whether you think we're going higher or lower. That's hard to really dispute looking at the charts. So, I view trading and formulating the bullish or bearish case sort of like, a trial in court where you have a case has to be built and you have pieces of evidence, and the more evidence you have, the stronger your case. So the first case, again, or the first bearish point or technical event will be to take out that bullish engulfing candlestick from Friday. Then I had this horizontal line here around 108.08, which defines the top of this trading range really that occurred following this breakout. And you can see how just how technicals work. There was a pretty well-defined trading range. That's why I have a line there. And then you can see this big green bullish candlestick, so that we broke out with force, had a big strong day and closed above, and then we traded above that level and back tested it almost. Well, I have that line. I just had it. I should say it was the bottom of the bearish. This was that other line. So that would be your next level, 108.08-ish. Call it 108 to be safe. That would be bearish technical event number 2. This starts to really chip away at the bullish case, as I mentioned. And then the real damage comes when we get down here back to that 105.85-ish level that I've referred to, which was the breakout here, of this basing pattern, and that will really start to increase. You'll probably start to see the selling increase, the velocity or rate of the markets going down, and until then, I don't want to get too excited about it because we can chop around in a sideways range. So really, that's why I had these lines color coded that way. That green line, really as I mentioned, this is where I don't think the market has. Where I should say where the bearish case rapidly begins to erode if and when we take that out. And that orange line there, that's pretty key support, where the bullish case will rapidly begin to erode if and when we break below there. But you need to be prepared for, the possibility that we could slog around between these two levels for possible weeks or more. Let's try not to read too much else into it. But again, the longer term, everything I've covered in the past plays into my expectation that this breaks to the downside, and and if I'm wrong, then this is where I start to adjust, or at the very least step back, start covering short exposure, which I'm not super heavy right now. I do have a decent amount, as I mentioned, but plenty of room to add if and when I start seeing the bearish technical case evidence build, as I was referring to earlier. All right, so let's just leave it at this. We'll look at the 60-minute chart. Here's the Qs, and again, I'm focusing on the Qs. That's where a lot of my focus has been, because this tends to be, at least in recent years, recent decades, I should say, really the leading index. With all the big tech companies, the stocks that have outperformed over the last decade or so, and certainly led up this in the entire bull market run off the 2009 lows. And you can see here, I have a lot of fibs. This chart's a little bit busy, but there's that trend line Again, we need to take out this yellow trend line. We're looking at, once more, a 60-minute chart. That would be a bearish technical event. The divergences, as I mentioned, I've been mentioning the divergence since back at this point. And yes, we went higher. Divergences had, in other words, continued to build and have only become more powerful now. This is just an extended divergent high. And typically, the larger the divergences, the larger the ensuing move to the downside. So the RSI looks like we made almost an equal high there. It might have been a slightly higher high, but we do have some divergence there more recently at this point. And there's that trend indicator that I follow. And you can see, the market has been, for the most part, in a confirmed uptrend since all the way back, at this point here, by most metrics. So that's just something else to watch. You can replicate that line. Keep in mind, on all but the shortest term time frames, I always use a log scaling. That's going to render a different picture on the chart than an arithmetic or linear scaling. Not a huge difference on this 60-minute chart, but it does sometimes come into play, especially on the longer term charts. So if you are trying to replicate these charts on the trend lines and things you see, just make sure you're using the log scaling. All right, so that's it, guys. Not a whole lot to get excited about so far, but the potential's there. So I give you a few levels to watch, and we'll just go from there. This has been Randy Finney with the right side of the chart. Have a great day.